Good morning, Money.net live. I've got a great contribution today for everybody. Dr. Alan Ellman of the Blue Collar Investor Group. I am so excited to have you today, Doctor. I'm gonna start calling you Alan. Is that okay?
Sure thing.
I love it. One of the things that I had mentioned pre-COVID that was going to happen was I thought that the retail investor was going to explode on the options scene because there was so much leverage there in order to bring it. And one of the cool things that I thought, oh my goodness, not everybody understands options. And my goodness, you don't only not only understand options, you've been doing it for 25 years and been teaching it for 15 years, and not just naked puts and calls, but you actually have strategy. So I'm very excited about that today. So welcome. How are you today, man?
Doing great. Looking forward to this interview.
All right. Well, the thing that you do the best, as you told me, is covered calls. Now, that's very exciting to me. So I'm going to ask, the first thing I ask you of you is, can you explain what a covered call is?
Sure. Covered call is really a two-stage trade. Number one, you buy a stock. It could also be an exchange-traded fund. So now you own the underlying security before you sell an option. So covered call writing is on the sell side of options. So step one is to purchase the underlying security. Step two is then to sell the option. So when we sell a covered call option, what we're doing is we're agreeing to sell our shares for a price that we, the option seller, determines by a date that we determine, called the expiration date. Now, the price that we agree to sell the shares for is known as the strike price. So, Steve, let me give you a hypothetical example of
Sure.
how this might work. We purchase 100 shares of a company, let's call it XYZ, the famous XYZ company, at $48 a share. Now, the reason I say 100 shares is because for every one options contract we sell, we must first own 100 shares of that underlying security in order to be covered or protected. Now we own the shares and we're free to sell the option. So let's assume in this hypothetical, Steve, we sell the $50 call option. That means we have a contractual obligation to sell our shares for $50 at any time over that contract cycle. Let's say a monthly contract. So anytime over that month, we are required to sell our shares for 50 if the option buyer elects to exercise that option. Now, in return for undertaking that contractual obligation, we're paid a cash premium. Now, a typical premium in an example like this would be $1.50 a share or $150 for the contract. Now, if that underlying security is more volatile, the premium would be higher. If it was less volatile, the premium would be lower. I'm giving you like an average.
Sure.
So if we generated $150 on a cost basis of $4,800 in 1 month, that's a over 3%, say 3.1% 1 month return initial. Now, does that mean we're going to get that? Well, we might get more, we might get less, but that's our starting point, Steve. We get paid the cash premium. We click the button on our computer. The cash is in our account. Now, Steve, at the end of that contract, there are two major outcomes. The first major outcome, let's assume for a moment that XYZ does not move up and supersede that $50 agreed upon sales price. Well, that guy over there who bought the option is not going to elect to exercise the option and buy our shares for 50 if they're still trading at 48 or any price under 50. What happens? The option expires worthless. We keep the 150. We still own the shares, and now we're free to sell an option the next cycle. The second possible major outcome is that the price of the stock does in fact move higher than the $50 agreed upon sales price, the strike price. We take no action to buy back the option, which we can always do that, but let's assume we don't. Our shares are sold at 50, the Saturday after expiration Friday. Where do we stand? We made 150 on the premium. We made 200 on the stock. That's over a 7% 1 month return. So that gives you the parameters. Now, let me just say one more thing, Steve, before we continue this conversation, because I don't want your listeners to think that there's no downside to this strategy. If the price of the stock drops below the break-even price point, in this case 46.50, 48 minus the $1.50 premium, we could start to lose money. So there are pros and cons, but generally speaking, we're starting off with a credit when we enter these trades.
That is probably the easiest explanation I've ever heard in my entire life of 33 years of doing options of how to process covered calls. I mean, I guess that just comes from, 25 years of doing it, the number of books that you've written, contributed to the Options Industry Council. I'm reading all this stuff. I don't even know what to call you. You're so smart on this stuff. Let's get to it, right? How did you all get started? I always want to turn the clock back just a little bit. Tell us a little bit how you got started. I guess in the very beginning, you have a great story. I've heard this once. I love this story. Tell everybody the story of how you got started.
Well, Steve, I started my professional career as a dentist, and I had a practice in New York with a partner and a staff of 15. Now, of those 15, four were dentists, the three were hygienists. So in total, we had 9 producers in our practice. Because of that, I was able to work, my partner and I, 25-hour work weeks. I know you work much more than that. You're such a hard worker, but I was able to work a 25-hour work week and still support my family comfortably. But what happened was in the 1990s, I realized that at some point in time, I would need a passive form of income. And I had no clue how to invest or self-invest. And Steve, it just wasn't in my DNA to hand my money over to somebody to invest for me. Not that there's anything wrong with it if you get the right person, but it just wasn't the way I wanted to do things. So I started to teach myself how to self-invest in the stock market and in the real estate market. And I always had a little bit of a knack for math. So I started developing rules and guidelines, formulas, equations, algorithms, calculators, how to invest in those two venues. In 2006, I was invited to speak before a large real estate club on Long Island, 250 investors, regarding some deals I was executing in Austin, Texas. And it showed how I took one investment property that I owned in New York and converted into 5 properties in Austin without taking a penny out of my savings account. But during that presentation, Steve, one sentence came out of my mouth that was about to change everything for me. I said that I purchased my first investment property with the profits I earned from selling stock options, covered call writing. Well, after the presentation, people were coming up to me saying, how do you do that stock option thing? They weren't asking me about the real estate. And then I started getting emails and phone calls. How do you do that stock option? So I said to my wife, Linda, maybe I should write a seminar on how I do this. So I wrote a basic seminar on covered call writing. The woman who owned the real estate club was very generous and allowed me to send out an email blast to all her members. I rented out a room in a local Holiday Inn, sold out.
Wow.
I couldn't believe it. So I wrote 3 more advanced seminars, sold out. And I kept on doing these 4 presentations and I kept selling out. So one day it hit me, I think I have enough here for a book. But, being a math science guy, I didn't know if I could write a book. But here's where I got lucky, Steve. I mentioned to the woman who owned the real estate club that I'm thinking of writing a book based on these stock option seminars. And she said to me, Alan, I own a small publishing company. I'd love to publish a book. Well, that made it easy for me. So for 6 months, she came over to my house on Friday nights. She showed me how to write a book. And in January of 2007, Cashing In on Covered Calls was published. Now, 3 months later, the publisher calls me up. Alan, you're sitting down? I go, what? She goes, your book is #1 on Amazon on stock options. I said, are you kidding me? Anyway, I've held that #1 slot now on stock options on Amazon for 15 years. and I just recently published my eighth book. And of course, then all hell broke loose, and I started getting invited to speak all over the country. So, Steve, in 2011, I realized I can't do both anymore. I can't do dentistry and covered call writing presentations. And I made a career decision. I gave my partner 2 years notice, and I hung up my dental drill in 2013. And here I am on MoneyNet. You can't beat that, right, Steve? And I
I was
just
about to ask you to, I might have get my teeth cleaned every 6 months. I might have to ask you to do that. But that is a great story. You always hear from all of these investors and educators in this world about how to do things, and it to a lot of people, it just seems so outlandishly hard, and they can't get it, they can't grasp it. One of the cool things about you is you laid it out so easily for people to understand. One of the cool things that I think for money.net users is very simple. How do they get a hold of you? Do you have a website?
Oh yeah, you could actually see it behind me. It's thebluecollarinvestor.com. bluecollarinvestor.com. Actually, I answer my emails too. It's Alan, ALAN, at thebluecollarinvestor.com. And yeah, there's a lot of information on the website. Perhaps your viewers can see behind me. There's a blog. There are opportunities to visit our store. We have DVDs, books, and so on. Plus, there are also videos up on the site. So yeah, there's a lot of information available on the site, and I do respond to my email questions. I love sharing the information that I've learned pretty much the hard way. And you've been around the block a few times, Steve. In order to be really good at something, you got to take your lumps. You got to make a mistake and correct it. So if I had a losing trade, I would always analyze it. How could I have done better? Could I have turned this losing trade into a winning trade? Or could I have mitigated some of those losses? Or even, hey, I had a great result. Could I have done even better? And my eighth book that I recently published is only on position management for covered call writing, and the other strategy I'm known for, selling cash secured puts. There were over 20 different exit strategies between those two groups. And not many people know how to manage their trades. They know how to enter them. They know how to buy a stock. Okay. They know how to sell the option. But then what?
So you're saying that it doesn't matter where that person is in their journey of learning, beginner all the way to advanced, you're willing to teach them all the way through.
Yeah, because in 25 years of doing something, and I narrowed my investment strategies as far as stocks are concerned to these two strategies. I think some retail investors make the mistake of trying to learn 10 different strategies, and they know a little about all of them, but they're not really mastering any of them. So I would hope people would agree that I've mastered these two strategies. They've certainly done well for me and my family.
Yeah.
And so, yes, we have beginners. That's our demographic, but we also have a lot of professionals that follow our work as well.
So if a person is a beginner, how long is the course? How much time do they need to invest in your course in order to feel comfortable that they can actually sell their first call and buy their first covered call?
Well, I tell most beginners that they have to master three skill sets before risking even one penny of their hard-earned money.
Okay.
And those three skill sets are stock selection. Could be an ETF. So what stock are you going to select? I have to tell you, Steve, that right off the bat, one of the biggest mistakes that retail investors make is they'll look for a stock that will give the juiciest premiums, but those are also the riskiest stocks. So we teach how to mitigate that situation.
Good.
So stock selection, and we have a process for how to do that. Then option selection. In the example I gave, we sold the 50 call when we bought the stock at 48. That 50 strike is known as out of the money, higher than current market value. But there are times when we're going to want to sell the in the money strike, maybe the 45 call, as a defensive move. And based on certain market conditions, many of which we had in 2022,
Mhm.
In the money calls would be better than the out of the money calls. So option selection is important. And then the third skill set, equally as important as the other two, is position management or exit strategies. How do we manage our trades once we enter them? This is probably the weakest link for retail investors. They know how to buy
Yes.
a stock. Okay, they figured out how to sell the option, but then what? Then they curl up into the fetal position and pray.
I love it. It's one of my rules of trading. Always have an exit strategy. I think it's so important for traders to understand that okay, you're in the trade, but they don't know how to get out of it, right? Whether or not to position yourself or to take that profit, as a lot of people don't always do. I love that. All right. Well, I guess I just have one more question for you, Alan. This has been amazing, and I'm looking forward to some of our you clients actually coming to see you. But would you come back and hang out with us about once a week?
Oh, absolutely, Steve. Looking forward to it.
I love it. I'm loving the education side of money. All right, from all of us here, thank you so much, Dr. Ellman, and we'll see you right back here next week then.
Take care.